Thank you very much. And with this, we have last session for the day, last but not the least, on single factor versus multi-factor versus factor timing approaches. So we have the last panel, starting off with Siddharth Vora. Siddharth Vora is the head quant investment strategies and fund manager at PL Asset Management. He is a CA, CFA, CMT Level 2, a SEBI-registered research analyst investment advisor, and a portfolio manager. He holds an MSc in Management for Business Excellence from the University of Warwick and is one of the most definitive voices in quant investing in India. He spearheaded PL Capital's foray into the quantitative investing space and is the brains behind the quant-based flexi-cap equity, PMS, Aqua, which is style-agnostic and adaptive multi-factor strategy. Through the power of data-driven insights and cutting-edge technology, Siddharth has positioned PL as a leader in the quantitative investment space. For his innovative work in quant investing, Siddharth was recognized as one of the most influential young leaders in Asia by India in 2022. So, welcome. Ritika Chhabra. Ritika Chhabra is a fund manager at Edelweiss Life Insurance, managing funds quantitatively. Before joining Edelweiss Life, she was a founding member of the quant-driven PMS at PL Capital. Prior to that, she has worked with the think tank FRG, consulting Ministry of Finance and other government bodies on systematic risk measures, and as an EM equity strategist with HSBC Global Markets. She holds a Master of Science degree in Economics from Indira Gandhi Institute of Development Research and has done industrial engineering from National Institute of Technology. Welcome. Third one we have is Aditya Sharma, CFA, who is the Director of Alpha Signals at S&P Global Market Intelligence. Aditya manages quantitative and alternative data products within the Market Intelligence division at S&P. He joined S&P Global Market Intelligence following the S&P Global and IHS market merger in April 2021. Previously, he has held data science and strategy roles with global remit at Western Union Business Solutions in London and social market analytics in Chicago. He has worked closely on projects involving machine learning and natural language processing application in finance. Aditya holds a Master of Science in Finance from Illinois Institute of Technology, US, and has done electronics and communication engineering from the National Institute of Technology, India. He's a current member of CFI Society of the UK and Chicago. Welcome. Last panelist, we have Rohit Beri, who is the co-founder and CEO of ArthAlpha and is an accomplished data scientist and investment professional with extensive experience in quantitative investment, financial engineering, and data science. Before co-founding ArthAlpha, he was the CIO at True Beacon. Previously, Rohit co-founded Riemann Capital Singapore, where he advised institutional investors and family offices on financial data science and traded Indian equity derivatives using deep learning models. He also founded a quantitative hedge fund, Roaring Numbers, US, later acquired by a family office within the first year of operations. Rohit is a chartered accountant turned data scientist. He's also a CFA and Sloan Fellow MBA from Stanford GSP. With this, we welcome you. And lastly, to moderate the overall session, we have Mr. Sunil Ramrakhiani, who is the Chief Business Officer at BSE since May 2023. He has been part of the new BSE leadership team, instrumental in bringing liquidity in BSE derivatives segment and making BSE vibrant. He has over 26 plus years of diverse experience in Indian financial markets in various strategic and leadership roles. He has worked across exchanges, treasury in bank, broking, property trading using low latency technology, high frequency trading, and wealth management. In his previous roles, he has been instrumental in initial stages for setting up of Alpha Grep Securities on the product committee on exchanges and advisory committee for framework for AIFs and interface with regulators for development of markets. So, once again, welcome, and we look forward to hearing from you.
Uh, Thanks for the introduction and welcome the panel. Maybe I need to learn a lot from you, all the young, bright minds. Some of the guys I know from the past, my immediate panelist, which I caught him back after 20 years. And one of the things which I learned from the previous presentation, randomness is a factor. So interesting part. So we all live in randomness. In one of the books which was lying on the table was Fooled by Randomness. That was, I read almost 10, 12 years back while we were trying to build a lot of stuff in the quant space. So today's session is largely about the understanding what these guys are doing in terms of their approach towards managing the money, building out strategies, whether they are using a single factor, multi-factor, or they are using also the timing of using these factors. So typically, I'm sure a lot of, I'm happy to see the crowd sitting in the last session, which is typically Friday evening. First thing and foremost, I want to congratulate Rishi and the team. Pankaj, I believe, is one of the guys. They have done a wonderful job in a short span of joining Laksa. Trust me, I was not following so closely. And interestingly, I came to know that Rishi also has got lineage in terms of the career on the other side of ICICI when I was in the buy side at ICICI. But many, many congratulations. It's going to be just beginning. I just told him, why don't you do this next year at BSE? It's a BSE iconic hall. We are doing at 150 years this year at BSE. A lot of things are happening at, maybe I'm not going to rush into BSE's marketing over here because we are here to learn from the experts onto the panel. So single factor, multi-factor, and timing, that's very, very important part which we want to learn. So this first question is for all the panelists right now sitting around with me. You can share your experience in terms of your and your firm's experience in terms of relation to single factor or multi-factor strategies and how you have built those, what has been process for building or creating those factor-based models. You can share with all out here. Maybe Siddharth, you can start and then other panelists can just handle that.
Sure. So at PL Capital, we run a purely quantitative driven portfolio management services, and we're managing roughly 500 plus crores quantitatively on the PMS platform. And we use only one strategy for now. It's called Aqua. What we've done over the last 3 to 4 years is we've obviously tested every possible iteration of single factor strategies, multi-factor strategies, and multi-factor strategies that have a factor timing feature also. And what our test results suggest is that single factor strategies usually perform very well in certain phases of the market. But if you look at a long-term market cycle, say 5 years, 10 years, 15 years, then they would have slightly lower returns and a much lower Sharpe ratio than multi-factor strategies. The simple reason is, of course, individual factors are highly cyclical in nature, and you have a lot of factor concentration risk. The moment you move out of single factor strategies to multi-factor, your cyclicality reduces and sustainability improves. But the downside of multi-factor strategies usually is that it dilutes the exposure of the dominant factor in any prevailing cycle. For example, say we are in a value and momentum cycle like we've been since 2020-21. So the last 3-4 years, these two factors dominated. A multi-factor approach would also include, say, a quality aspect, a volatility aspect, or a dividend and growth aspect. These would ideally dilute some returns in this phase of the market as opposed to a pure momentum or a pure value momentum strategy. So I think these are the pros and cons of single factor and multi-factor. And what we've done at PL is we use a adaptive multi-factor strategy or simply a factor timing or a factor rotation strategy. Again, this is based on all the test results that we've run for the last 20 years. And we've concluded that this is probably the most sustainable way of managing money. It gives you the best of both worlds. It gives you, a diversified factor exposure also. And it gives you the ability to concentrate on a few factors in that cycle. So I could have value, momentum, quality, volatility, say all equal weight in a multi-factor approach. But in a factor rotation or a factor timing strategy, I could overweight value and momentum when they are the best performing factors, underweight value momentum when their cycle has reversed, overweight quality, low volatility when they are doing well. So I think it gives you that edge, that adaptability to ride through the various cycles of the market. So from a Sharpe basis, returns basis, sustainability basis, I think a factor timing approach is probably more robust in Indian markets. Of course, that it also has some risks. The risk is that factors persist for a slightly shorter period of time. So within 6 months, you could see 3 or 4 cycles of factors changing. That's a phase which we call a transition phase, and then your models would get confused and wouldn't know which factor to really chase in that part of the cycle. So I think factor persistence is a risk. And the second risk is that the model detects, say, quality regime, but markets play out with a momentum regime. So there would be a difference in accuracy in what you detect and what the markets actually perform with. So I think detection risk and persistence risks are the 2 key risks of a factor timing approach. But net of all of that, over a long cycle, I think factor timing approaches are a little more robust and resilient.
Yeah, Ritika, you can.
So at Edelweiss Life, we manage all our funds, be it pure equity funds or multi-asset funds quantitatively. These are not per se quant funds. We don't call them quant funds, but they are actually the approach, investment approach is to manage them quantitatively. So we have 6 pure equity funds, 3 large cap, 1 multi-cap, 1 mid-cap. We've recently launched one small cap, and all of them are managed quantitatively. So how we go about portfolio construction is we divide our portfolios, funds into core and tactical portfolios. So in core portfolio, where our holding period is slightly longer, what we do is essentially follow a funneling multi-factor model, where we are funneling through first from our investment universe. We screen out the companies which are not, might have balance sheet issues or earning quality issues, corporate governance issues. After screening out for those, we essentially follow what we call in fundamental as CARP and GARP, quality and growth at right price. So we use a combination of quality and growth indicators and find the stocks which are ranking top using a combination of these. And the final selection is based on, value, where we find these quality and growth companies which are trading at inexpensive valuations. So that's about our core portfolio. For our tactical portfolio, we essentially use a lot of macro models and sentiment indicators to find out the regimes, and that's when we do factor timing in terms of, which a particular factor to take exposure to, and also sector rotation as well. We do, 2-3 industries we try to identify where, we can generate short-term alpha. So this is how we go about dividing our funds into 2 kind of portfolios, core and tactical, and usually the distribution that we have is approximately 75 to 80% of the funds are in core portfolio, while 20 to 25% are in tactical.
So sort of a different approach, because where I come from S&P Global, we are a data provider. I think a lot of you in the room would know our index business and the rating business. But a much bigger and growing part of our S&P is the market intelligence division, where we are providing data on equities, fixed income, and other asset classes. And the way that we have approached this is S&P has grown by a series of acquisitions and mergers. And all of these different companies, what we have been really powering through is collecting financials, collecting fundamental data, but at the same time also creating alternative data sets from our existing resources and the data assets that we have collected over the years. So when it comes to single factor versus multi-factor, at the core, we are collecting all of this data at source. We have all of the financials and the fundamentals. So when it comes to finding, let's say, a single momentum factor or a value factor, that's what we started with, let's say, 25 years ago. But over the years, as the market has evolved, as the demands for the data sets have evolved, we have started thinking about creating a multi-factor approach in terms of, okay, what do we think about a long-term plus short-term momentum factor? How do we identify value plus growth? And value and quality and momentum as a factor. So what we have been focused on is creating more and more data sets which empower our customers to be able to incorporate that data directly. As Ritika mentioned, there are a lot of filtering applications. So how can we provide that data which is point in time, mapped to the right identifiers? I think in the previous panel at backtesting, we were talking about survivorship and look-ahead bias. So how can we solve all of those challenges so that customers are able to just come in and apply those strategies directly, whether it's multi-factor or single-factor, that's irrelevant at that point. And then lastly, because of the business structure that we have different items such as our purchasing managers index, which is a very, very macro data set. So we have created more of sector rotation models, industry rotation models, and factor rotation ideas that allow our customers to do their factor timing and essentially identify which cycle that they are in and adjust their portfolios accordingly.
Great. Yeah, Rohit.
Thank you very much. I'm Rohit Beri from ArthAlpha. We are probably the newest kid on the block. We are about a year and a half old firm. We're basically AI-driven quant shop. Currently, we are running our maiden first PMS strategy called ArthAlpha MEQ, Machine Learning Equity Quant, and we're in the process of launching our long-short business as well. I think Siddharth pretty much summarized the thought process. I'll just add a very tiny bit to it, saying our research happens at a single factor level. Our model construction happen at a multi-factor level, and our alpha generation or portfolio management happens with factor timing. You can't build multi-factor portfolios or multi-factor strategies without first individually identifying alpha factors. 90% of the job is identifying alpha factors, removing noise out of those factors and improving the efficacy of those factors. For us, even a single factor, when we say, let's say a momentum factor, usually ends up being a combination of 20, 30, or even some cases 50 different ways how we define momentum, and then we combine those 50 different signals into a single factor, saying this is how we represent momentum, or this is how we represent value. Each individual factor is well researched. Our success rate in our thing is if we research 20 odd factors, then maybe one out of those 20 factors is an alpha factor, and rest 19, it's like doing gold mining. And then you carefully construct those factors, use multitude of factors to reduce noise, improve the factor efficacy, and then moved on to multi-factor model. The idea of multi-factor model, as Siddharth earlier talked about, that you need to reduce the cyclicity. Our single factor construction can actually perform very well, almost as good as multi-factor, because our single factor is a combination of multiple factors. But the cycle part is still an issue. So to reduce the cyclicity, we have to bring other factors into the picture. And finally, to build a successful, long-lasting, active investment management shop, consistency of your returns, or as we define our returns is only alpha, matters a lot to investors, because investors are looking how you're doing. They talk about being a long-term investors, but when they look at their portfolios, they are looking at a quarterly performance, semi-annual performance, or you're as good as your last 2 quarters performance. So factor timing becomes very important. Sometimes factor timing even can take away a little bit of your alpha, but that consistency matters a lot to investors. And what we see is with that consistency comes higher information ratio, but sometimes you actually end up paying a little bit of a cost as well. But for a successful fund manager, I think that consistency is far more valuable than few basis points of information loss. Thank you very much.
Great. So first question was well elaborated, and interestingly, factor timing is something which is very, very close to my heart actually in terms of I heard Siddharth talking about a very robust model you already built up for the factor timing, and Ritika talked about typically on tactical portfolio, you're using the factor timing, and he talked about the factor timing, which is very, very important, where you have to give the loss. I come from the high frequency world, where timing is everything. So you guys are talking about the overnight and quarterly, we talk about in microseconds and nanoseconds. So I'll move to the next question for my panelists, not HFT world, but definitely a much more, not a high frequency data over here. We already talked about benefits of using these kind of approaches, but I'll move to the next question in terms of active versus passive investing. It's for all panelists. How you differently handle these factor approaches when it comes to the active versus the passive investing? I know we got one passive, which is S&P over here. Other guys are active guys here. Please share your thoughts. Maybe Rohit, you want to take up this?
Sure. So I come from active world and rather hyperactive world. We are probably, as far as I know, we are the only long-only fund in the country who does daily rebalancing of our portfolio. But I have done a tiny bit of work on passive side and mostly academic research. I think one of the biggest differences I see with my limited knowledge is that when you're building a passive portfolio, you have to look at a performance of your strategy across the cycle. You don't have a choice where you say, listen, I can look at those short-term variations, try and capture. The life becomes very, very hard. So the cycle, you have to live through the cycle. An active guy like us, I started, in India market, I started working in August, in 2021 when I moved back from Singapore, and I launched my first AI-driven quant strategy in August of 22. Since then, our model has evolved. Our model has changed 6 times. We are not playing just with the factors. We are playing with the model itself. We throw factors out when we believe that factors have run their course. And market has so over-abused them that there's never going to be any this thing, and new data sets are coming. So I think for passive guys, taking advantage of those is almost impossible. The other thing is the churn, right? If you are an active guy, your churn tends to go higher. Because you are changing your models, you are revamping your models, and at least from our perspective, the way we think about it, if we have a newer way, better way of doing this, we will just go and do it. We want to be as close to the model as possible. We don't want to wait 3 months to churn our book, change our factors. We do it very, very fast. So I think the two universes, while they are analyzing the same data sets, they are to some extent departing from the insights. As an active guy, I can take advantage of short-term insights, whereas passive guys don't have that luxury. Their life is a little more difficult. But you know, that from my limited perspective, that is one of the biggest differences I see.
Yeah, I mean, I would echo what Rohit said there. I think at the very basic core, what we're doing is rule-based logic investing, right? We're trying to build these rules using the data set. Now, when it comes to passive investing, the rules and the inputs are quite limited. You can't really use high-frequency data or data that's reactionary, that's changing quite well. So you're relying on things such as value or quality. Maybe you're getting into the estimates data set and the momentum data sets. But with passive, it becomes very hard to do this very frequently. And that sort of excludes a major proportion of the data sets which are giving you the edge or giving you that additional alpha that you can react on. With active investing, you could have a shorter turnover or a lower turnover and a shorter holding period. But at the same time, you have the ability to choose the data sets that you are that are out there, that are coming up with. I mean, the previous panels did talk about the availability of data sets, the quality of data sets. And with the technological advancements, we are seeing more and more of this come in, right? Something that has been around for a long time, like earnings call transcripts. You would see an analyst reading it, sort of applying it, doing it fundamentally. But now with NLP and LLMs, what we have is the ability to consume them at scale, create signals from them at scale. But for a passive investor to be able to use that, it's still very difficult, whereas an active investor is able to incorporate that sentiment, react upon it quite easily. So when it comes to multi-factor and quant investing, that logic-based approach is much easier and much more nimble and suited for active investing. And at the same time, as Rohit mentioned as well, that pays off. There is a higher churn, there is a cost of data set involved, which I think we haven't talked about, but that's quite important, right? Like the cost of data set is involved, but that cost pays off 5 times, 10 times, and even more. So I think that becomes quite an important factor, no pun intended, but quite an important factor in the investing strategy there.
Yeah, so basically there's another problem with, say, single factor passive is that it can be susceptible to overcrowding. Say, if I'm using a very simple momentum, 12 minus 1, and everyone's invested in that ETF, or everyone's replicated that strategy, 12 minus 1 calculation of the momentum. So when everyone is churning at month end, so it will have high impact cost. The moment you go and rebalance your portfolio, that particular stock A, which has come in your portfolio, is already up by 10-15%, given the volatility we kind of seeing in this market. That is one problem. And another thing which is not, I think, especially with passive instruments is, just like Nifty, you can forecast which, because the rules are so simple and transparent, you can actually forecast which stock is going in and going out. It actually happens when hedge funds and arbitrageurs are taking opportunity of that. So, exchange says that in Nifty, say, so-and-so stock is going out and so-and-so stock is going in. We can already see a lot of movement in that particular stock before the actual rebalance happens. So your factor premia actually reduces when, there are a lot of, when the information is available freely, which active investing will not face much problem in that.
So I think beyond everything that all my other fellow panelists have already talked about, there are probably 2 points I would like to highlight in this whole active versus passive quant. One being that factor spreads are very, very important to understand when to go to passive instruments and when to stay in active instruments. Just to give you an example. So in phases when factor spreads are very large, which means 1 or 2 factors are actually performing significantly better than most other factors. This is a phase when factor spreads are wide or large. Then there is another cycle where factor spreads are extremely narrow, which means all factors are pretty much performing in the same range. I could also say that factors are not able to explain investment returns. So in phases when factor spreads are large, taking a passive approach using, say, a value momentum fund or a quality fund would actually give investors an edge. In phases when factor spreads are extremely narrow, that's the time when single factor, passive funds would underperform significantly if you're in the wrong factor. In a phase of narrow factor spreads, a multi-factor approach or a benchmarking approach would do much better. Other than this, the other point that I would like to highlight in the active-passive debate is quantitative strategies, say, designed for value, momentum, or quality, would usually not be able to avoid a value trap or a momentum trap unless it is also blended with few other factors or an active overlay. To give you an example, you could find a lot of value stocks quantitatively where fundamentals are actually deteriorating. And the quantitative filter will only capture that as value. But an active overlay of quality or momentum or growth would try to keep you out of that value trap. Similarly, if you're chasing momentum without taking into consideration other factor, you're probably going to end up in a momentum trap. And therefore, you need to sort of understand that these are some of the risks of passive investing strategies which use quant to define value, quality, growth, or momentum. And therefore, an active overlay would most likely have an edge over a long-term cycle. So I think these are some of the points we need to keep in mind.
Quite interesting stuff from all the fellow colleagues. Interesting, one guy doing a everyday rebalancing, other guy says 6 months. And the market regime, when you have to become active and when passive, I want to check on that, allocating my money towards that. I can't put my money onto the PMSs, but when to put into passives, when active, just very, very interesting thought process. Given my fellow panelists have got a lot of specialization onto something, my immediate fellow panelist is a long short factor specialist. So I'll pick up brains from Rohit. If you can give his thoughts in terms of how he's using what factors for building out a long short strategies. And given his global experience, he can.
So, long short is a very different universe from long only. As I say, there is no place to hide. In long only, you have beta, you can say beta messed you up. In long short, 3 months later, if a client is going to wait for you for 2 quarters on long only, he's probably waiting for you to deliver in 3 months on long short. So, long short, long short, there is nothing called multi-factor long short strategies. I think one of the guys at Renaissance Technology said, listen, we run hundreds of different single factor models. It's a simple linear regression at max, where we have a factor and then we apply a linear regression when we make a prediction and we build positions on that. The way you do multi-factor in long short is you run hundreds of such factors, and if you are Millennium or a Citadel, you're probably running tens of thousands of such factors, and probably at Renaissance Technology, I don't even know how many factors they will be running. What you're doing is you're allocating a very small portion, and you are a machine, you're a factory, which is just churning out these factors, improving upon these factors, but your portfolio is largely constructed of single factor. Why? Because you can improve that single factor and you can build uncorrelated factor. The biggest friend you have is correlation when you're running a long short book, because here you can neutralize your risk, and if your factor returns are uncorrelated, now obviously the holy grail is -1 correlation, which we all know. Even if it exists in a good environment, it never exists when things matter, when downside correlations, people get correlation breakdowns. But if you are able to take advantage of less-than-1 correlation across multitude of single factors, you're able to improve your sharps dramatically. That is how long-short investing is looked at. And over there, factor timing, by the way, also plays a role. And factor timing over there plays a role is how you position size. What kind of capital allocation is going to go on a particular factor based on the macroeconomic environment or factor momentum or variety of other approaches. So you do all three, but in a very different approach from a long-only book where multi-factor means you're combining a lot of factors, but in long-short you're running single factors, but you're combining the portfolios.
Interesting, actually, and very importantly, early in my career, I always was intrigued by the absolute return strategies, which are typically hedge funds. They run globally. We are talking about long-only kind of stuff because we last 4 years one way. I know last 3 months have been tough. That's where the absolute return strategies really come into play. That's where the long-short kind of stuff and non-correlated strategy. I saw a lot of graphs in the past, non-correlated in a different market regime, what they have to do. So long-short evolvement will happen for a period of time in India because non-leverages are allowed in India, those things. Somebody was talking to me, why not 2x kind of ETFs available in the markets? One of the guys sitting out there, I think Hitesh Idnani was there actually. Why I'm talking about those things is because in early stages of my career, we have been always intrigued by all these kind of approaches, which are now starting to get mature, which are globally very, very mature. The name of the firms, Renaissance or Citadel or MLP is one of them, very, very popular guys who keep on generating those alphas with so many guys getting hired from IIT every year. On the asset management trainees generating alpha, getting integrated with their PMs, and they get a upside onto that. I'm sure the panelists know about that because I used to hire somewhat of time. So I now to pick the brain. So it's going to be individual questions, so other panelists can relax when question comes to them. Now questions for Aditya, actually given his global experience. We'll move to data, which is very, very important part of the overall approach in the quant investing. So there are new set of data which are there, and technology becoming more and more important globally in terms of factor investing. So what are the new developments you are observing in the global world of factor investing? If you can share about that perspective, that would be really nice for all of us.
Yeah, absolutely. So I think the demand for fundamental factors and fundamental data, I think that will continue and that will always be there, because if you think about it, that's your bread and butter. If I take an analogy of, let's say, baking a cake, right? What do you need? You need your basic ingredients. You need your flour, sugar, eggs. That's something that you absolutely need to be able to start baking a cake. What becomes interesting is what kind of specialty are you able to add to it? How can you make it the most flavorful, the best bakery in town? And that's where your secret sauce starts coming in. And when we think about quant investing, secret sauce is something that a lot of these firms tend to focus on, including some of the panelists that I have here, right? No one here is going to tell you exactly how they're trading these factors. But to create that secret sauce, what you need is data, quant process, and technology. With the advancement in technology that we have seen in the last few years, I think it's just phenomenal as to how much data you're able to consume at length. The quant process comes from all of the great people who graduate, from the great institutes here. So the variable that remains here is data. Starting with the fundamental data, a lot of demand has started coming in for alternative data sets. So what's out there which is not correlated, as Rohit was talking about, and as Ritika talked about concentration as well. So what's out there which is not already captured in the market? Where can I find that alpha? How can I complete that data mosaic of getting information on each security? And we tend to dub this as alternative data, but alternative data is nothing but data that has not been used to trade that asset class. So it does not have to come from satellites or car parking lot. It can come from other asset classes as well. If you're an equity trader, what's happening in the corporate debt market and how can you incorporate that? If you're an options trader, why don't you look at equity market and start incorporating that data? And that starts becoming more and more important, and something that's interesting, what we call cross-asset alpha and the spillage across asset classes. The other thing, as I touched upon briefly earlier, is the NLP-derived signals, right? There is a lot of information that's out there when you start thinking about news sentiment, social media sentiment. Retailers have started taking up major positions in the market. So how can you start incorporating all of that information into the market and get more information there? And lastly, I think, what is the other person doing? So when you start thinking about institutional flow, so what kind of interest are we seeing from active investors and passive investors in each security? What kind of buy-in and sell-off trends are we seeing? How much liquidity is being created through these different types of institutes? So all of those data points are becoming more and more important. And when we start completing the overall picture here, what you're seeing is you get your value, your momentum, your quality metrics, but you're also looking at the interconnectivity of these using these other data sets, these other data points, and how these uncorrelated or low correlation data sets start adding value to the overall fund strategy.
That's an interesting perspective. I can share about the live experiences, what I'm going through this kind of a data requirement as an exchange business guy. Interesting part is particularly about the flow data, which is very, very important these days. What are the kind of flows which are coming from the active guys to passive guys. So I'll give you one snippet about the data, which is requirement coming in from the high frequency trading firms, the names he talked about, Citadel or all these big names, you talk about them, Susquehanna or IMCs and Optiva, all the big names who are in the, and definitely a name in the market is Jane, MLP and all that kind of stuff. So interesting is about that is data flow is so important these days. Who are building positions, whether coming through algo, non-algo, active orders, passive orders, what is the kind of open interest getting created on the micro nanoseconds, tick by tick data. So we will deal in that tick by tick data, which is terabytes of data every day. And that's why particularly for the community which is sitting around here, the data what we deal is for one sort of segment as an exchange, but the kind of segment which is sitting here is very, very large, which is subscribes to our data on the regular basis through different vendors or directly also for you doing your back testing of your any kind of a strategies which you are running for the last 10 years data. Because interesting, one of the US firms took a data of last 30 years from us and they paid hefty amount for us. We are wondering why they're taking that kind of data from us. That's the kind of work which is happening in the global markets now. So since this is a quant world which we are sitting around, please take advantage of the data which is available with the exchanges these days. You get all sort of data which you cannot find anywhere. With any of the vendors, though might be do a bit of work which you have to do, but that data is available at a, so we are creating that kind of products for the market. You come and click on the website, just like any kind of purchase you want to do that, go and take that data. That's going to be the future of even reaching out to the end customer. And particularly for quant world, that's going to be the very, very important part of the stuff. So interesting perspective, Aditya, and now questions of Ritika and Siddharth, they can take that. So we continue with data as a very important part. The quality and transparency which can be enhanced to improve effectiveness of all these strategies, credibility of factor-based model. So this data, that's what again, importance of the data, quality of data becomes very, very important. How do you guys ensure that cleaning the data? I think somebody touched on to one of the point is cleaning and relevant data which is being used. But there's so much of data now. The challenge today is we are using a news parse model actually, which is typically there's so much of data coming on. I think you rightly said about what you have to take in, what you don't want to take in. There are so many models which are running right now, particularly the names what you talked about, Renaissance and all. Last 12 years they've been using news parse models actually. We tried to build in our earlier name of the company what somebody mentioned in my introduction. So those things are already there in terms of that. So how you really, guys, that may not be relevant from your firm point of view. So how do you clean your data and what are the factors you are used? Because there's so much of data which is not relevant and sometimes data itself is not right. That's what we observed, particularly for which are active-based strategy which are being done in that case. How you guys do that process, maybe for the benefit of the crowd who has come to learn about that, if you can give them some highlight about that, what is approach for cleaning and what relevant data we use for building your models. Maybe Siddharth, you want to take up that?
Yeah, sure. So I think data is the basic raw material for all quant strategies. And I think India is currently evolving in terms of how many different factors we are starting to consume. India is probably not at the stage where US is in terms of, the breadth of factors that we have access to. Because I think most price and balance sheet based factors still have a history of 10 plus years. Whether it's social media or news-based sentiment, I think these would have a history of less than 5 years. So the ability to backtest them for a longer cycle will be quite limited. In terms of, data quality, some of the basic things that, we do is, we obviously rely on the data vendor to provide us clean data. We check multiple guys and see who's giving good quality data. Our data team also, has their active understanding what is right data, what is wrong data. So we set that audit process in place. How to adjust for different sectors and industries. I think that is also very critical because you can't use the same rule of factor construction to apply to say industrials and banks and insurance companies. So you got to clean that out as well. Sometimes you also come across missing data points. So how to fill those missing data points is another important point. And I think outliers is also an issue where you have some extreme values that completely spoil the data set. I think you use some vincerization techniques to clean that data and make it more usable. And I think despite all of this, you might still have some errors in your data, which you probably got to live with for now, till better data quality vendors start coming in India.
Great. Now I'll move on to Ritika, particularly with the insurance segment using the factor-based model. So what are the factor approaches? I think you initially gave the description about that. And what are the kind of measures you take in terms of risk mitigation while building out your model? Because you have got a long-term portfolio construction, and you talked about a tactical approach towards for timing risk factors and risk factor timing. Give a more description on that.
Sure. So basically, life of an insurance portfolio manager becomes easier because you have a lock-in period of 5 years. So in that, just the design of the product is such that our investors are patient and they have a long-term horizon, and that becomes easier for us because if for whatever reason the strategy is underperforming, be it a macro regime or a factor cycle, it eventually gets settled because the cycles have become shorter, right? So usually you see the entire cycle in 5 years, and it basically gets settled. The intermittent volatility gets settled in case of ULIPs. I think from that perspective, it becomes easier for us to manage because our horizons are long term. In terms of risk mitigation, we put a lot of stress on risk mitigation, and I'll talk about data corruption is one of the risk. We put a lot of stress on that the data is not corrupted in terms of if, say, there is maybe some corporate action has happened, there are mergers and demergers, we try to, adjust the historical fundamentals based on that. There's a stock split, there's a corporate governance action which has happened, we adjust the prices. We keep even keep the companies which have got delisted because they were listed at some point of time, and we, to avoid survivorship bias, we need to keep them. Before actual rebalance, we do a kind of mock churn to see, which stocks are going on and going in and which stocks are going out, so that we can attribute, what has changed in the data and the factors which is attributing to this particular, these particular changes. Can we know what is the reason behind that? And we keep a backup of more than 2 years every time we rebalance, because we want to see whether we are getting the same repeated results, or if there is a data corruption, then there'll be a change in the past, the output in the past. So a lot of checks and balances happen. Attribution also, we try to attribute our live performance with the model performance to see, how can we attribute and split into slippages, impact cost, is there anything which we are missing? These are some of the things which we keep in mind while avoiding data corruption. In terms of risk management, apart from IRDA limits, we have our own set of limits, sectoral limits, how much overweight, underweight we can go, how much overweight, underweight we can go in stocks. We usually avoid stocks which have high debt to equity, high interest coverage ratio, high promoter pledge, low delivery volume. These are the kind of stocks we usually avoid. And every month we review our strategies, what is the drawdown which we have seen in the past, and if the current drawdown of the strategy is within the permissible limit. We generate stop loss report every day if any particular stock is underperforming, which we need to take a look at. So all of these factors are there which we look at for risk mitigation.
That's interesting actually. So different segments of the market, insurance companies have got a different approach, that's what I believe so. And so we got a good perspective today actually. So before coming to the last question, before opening up for the question answer, last question from the panelists. Very importantly, I know Siddharth and Rohit are building their businesses based on the factor-based investing or quant-based investing particularly. And initially, again, I keep on talking on my career because I was early on the stage in this kind of stuff. So when we used to talk about this alternate style of managing money, this alternate investment style, which is quantitative is alternative, unlike the fundamental and the other ways of managing money. So things in the global markets already, mature markets already evolved, a lot of hedge fund kind of structures and those kind of stuff. Now India is really picking up in terms of this kind of managing money. And when you go and meet the clients, what is the acceptability of this kind of approach in terms of allocating capital towards this? Because people want to hear stories. Typically when you go and raise a capital, they want a macro theory, company theory and all that, because in all this kind of quantitative way of managing money, you can't give theory there. It's all the mathematics and all the back-tested results. That's where the regulator also has been, you got a small case and all that kind of back-tested, but in typically AIF structure and all that, you might be going and talking about one-to-one kind of back-tested your strategies, and till the time you build your books on the different strategies separately. So what is the kind of acceptability which is happening in the Indian context in particularly? I know globally there's a mature practice into that. Last couple of years, mutual funds have started rolling out the quant-based investing, and one or two mutual funds have become very, very successful in doing that. I want to hear from Rohit and Siddharth, and maybe other guys can chip in that case.
So, I started my career in sales actually, 2002 in foreign exchange sales. I'll say there are three things. Story, investor education, and performance. You have to have a story to tell. Each one of us sitting over here who's managing money in quantitative framework has more or less has our own unique way of thought process. Figure out how do you want to package that. Packaging works. Now, content needs to be there, so packaging will only take you so far, but it is required. So you need to figure out what is that unique perspective you want to bring about, which is quite unique about you. For us, sharing this with the fellow men over here is been one about AI. We were probably the first fund in August of 2022 to use AI to pick stocks. And second was our entire approach was very behavioral psychology driven. So much so that I personally delve into neuroscience aspects of investing and human behavior. And talking about that in the right, in front of right set of people. You don't want to go too technical. Math, you can't talk math. You will lose 90% of the people. So you want to build a story around it. And you need to do continuous investor education. Unfortunately, that's the truth. You need to make people comfortable with your product. It's not their job to become comfortable, and the only way you can make them comfortable is while either you educate them or you have built a very long, successful track record which speaks for itself. And I think our industry is obviously very nascent, and there are few players over here who have done it over a long period of time, and so that is great. But I think these two things, and then we can hope for performance comes, and rising tides takes everybody along. So performance does that job. Storytelling, investor education, and hopefully followed by performance.
Siddharth, your experience.
So I think I've started raising funds, raising funds for the PMS over the last, say, 2 years. And I think the journey has changed significantly with when we started versus the adaptability now. I think overall, mutual funds, ETFs, PMS houses, everywhere you're seeing the percentage of quant AUM is rising very fast because the base is very low. And I think acceptability and story is very, very important from which perspective. For example, if you went to raise funds 1 year back, you would get it like this because they are already tired of storytellers. You know what I mean? So when long only active is underperforming, people will be like, okay, we heard so many stories, but the returns are not there. Let's try quant. Probably when quant goes through a cycle of underperformance, that's when they'll move back to guys with long only stories. So I think active and quant will both perform well over a cycle, but they will have phases when one does better than the other. For example, say over the last 6 months, I don't think many quant funds have done too well, right? And active funds have done better. Simply because this has been a risk transition zone. Factor persistency has been extremely low. Price and momentum factors, which are critical in driving returns, they've also not been performing well. And sector rotation has been extremely fast. So I think that these are phases when people might be like, okay, quant is good, but maybe active is better after all. And if you go through 21 to 24, June 24, in that cycle, whoever looks at quant funds performance will be like, okay, quant is the way to go. So I think your story will depend on which phase of the market you're operating in.
So interestingly, actually, you mentioned about which phase of the market, factor timing and all that. That will be having overlay in terms of what you're going to build onto that. 2006, again, some people don't have started their careers also. We did that trend following models, which is the CTS kind of use actually. And much earlier, raising capital, we used to manage some 200 crores kind of a notional exposure on the commodities market. And 2010, we did all these kind of factor models and all that stuff. Trust me, the kind of storytelling which we used to do at that time with the name of the company which you do that. 4, 5 of the models we used to run. Now the market is slightly getting more mature because one of the large mutual funds is successful onto that. Again, the regime, when they launched, the regime is changing actually. So that's again important in terms of, that's what was called as an alternate style of managing money. And while we used to pitch at that time was a 20% of your overall portfolio should be managed like this. That's a typically kind of pitch we used to use. Now people have made money so much in the quant-based approach, they are looking at 100% of capital into that. But in the current phase of the regime, is the underperformance. So again, there's a way I learned in my career in terms of acceptability, because I've done a lot of business development myself at the ground level, dealing with all the HNIs, super HNIs and all that stuff. So that's what I want to be very keen to know, where's acceptability, what kind of market regime. If you can overlay that, his long-short strategy, absolute return strategy becomes very important part of the part of your overall bouquet of your strategies which you need to go and do that. But even the current market regime, if you are underperforming anything, so that client does not have that patience. He immediately wants to remove his money. But anyway,
so I think structurally quant is going to be, more accepted in India as more quant strategy manufacturers come in, more data vendors come in, strategies, have a longer life. Everybody, like 2 years back, institutional players would be like, ride one down cycle and then we'll know if quant really works or no, because right now it's a bull market, everything will do well.
Yeah, actually,
so I think
Rishi is the guy who is the most mature guy running long short, market neutral strategies, absolute return strategy. I've been monitoring, you may not remember me, but he's one of the best guys who are in that funds for the long time on the long short side. But market is getting mature now, particularly, but this kind of long short of in kind of bull market, these products don't get marketed. Now this is the right time to go and market those kind of products. But interestingly, a very, very good conversation, guys. Now I open the floor for the question, answers. All the panelists, very smart guys around here. Please pick up anyone. Somebody the mic, please. We have enough mics here.
Thanks, interesting conversation. A question to Rohit and Siddharth. Given the tax advantage that mutual funds. Thank you, panel, for a fascinating discussion. A question specifically.
If you can tell your name.
Yeah, sure.
Yeah.
Sure, Sunil. So my name is Namit Arora, represent a fund called In Growth Capital. My question is to Siddharth and Rohit, because they are running products focused on this. Given the inherent tax advantage of mutual funds, how do you address that with clients? I mean, do you face questions for a PMS or a AIF? And I know structurally there's not much you can do about it. So one is any efforts with SEBI on a thought leadership policy advocacy basis, number one. And number two is how do you address the tax situation with clients? Thank you.
I'll take it. Sure. So I think right now what we're trying to do for the last 1.5, 2 years is prove ourselves, get performance in, get enough AUM in, and then become a mutual fund. So I think that's how we're going to handle the whole tax situation for now.
Slightly different thought over here. I think in India, somebody asked me to comment on the budget, expectation from the budget. So I said, off the record, I have no expectations from the budget. I live in India, I'm 46 years old. If I still have expectations, then I am something wrong with my brain. I only hope and pray that they will not mess things up further. So expectations from SEBI, see, the way I think about it is there is an inherent disadvantage I have on taxation. And on top of that, we are a daily churner, which means we have to pay short-term capital gains. So 7.5% additional tax which we have to pay. We just have to justify it by producing higher returns. It's as simple as that. And mutual fund framework, to be honest, the way we think about our firm doesn't even work for us because we can't charge performance fee. We do not have fixed fee plan. We have refused people who offer us fixed fee plan. We quote exorbitant fixed fee plans so that they run away. Our entire frame of mind is, if I have to produce alpha for you, I have to invest in research. More than anything else, I have to invest in smart people. So if we do that well, we are able to generate that kind of returns, tax will take care of itself. That's cost of doing business.
Thank you, Siddharth and Rohit. Very insightful comments. Just one quick question for Ritika. Would you say that you're sort of a pioneer in the insurance space? Because given the long tenure of your funds and the general perception about insurance companies' asset management, but what you seem to be doing is pretty radical, So would you say, is it a function of your personal interest, personality, or in the insurance space specifically, not mutual fund, AIF, PMS, is there any other insurance company which is taking this approach? Because I'm very impressed that you're actually following this across your market cap buckets. Just some thoughts on that.
So basically, ULIPs are like MF schemes, right? We are benchmarked, a daily NAV is generated every day. We compare ourselves how we are performing with respect to other ULIPs in the particular category. Say if I have a mid-cap fund, like you will compare yourself with your peers. We do compare ourselves, how are we placed. Essentially I want to say that ULIPs are just like mutual funds. It's just that the investment approach that we follow at Edelweiss Life is a quant approach. I won't say it's entirely quant, and that's why I like to call it quantamental, which is fundamental plus quant. Regarding if other insurance companies are doing the same thing, I think a lot of institutions are warming up to this idea of having screeners. At the back end, having a quant team which are building screeners, and then they select the companies, but the final judgment is taken by a fund manager which company to invest in, and they look from the fundamental lens as well. But a lot of companies have their small quant teams building screeners for themselves that can aid them in decision making.
Thank you, Ritika, and many thanks to Aditya and Sunil. Fascinating panel, and many thanks to Rishi and Pankaj on behalf of the entire audience here for putting together a very power-packed and insightful day. So big shout out to Rishi and Pankaj. Please give them a big round of applause. As somebody said earlier, in a very short period of time, Laksa is making big waves. So compliments to both of you.
Can we wrap up or anybody is there? One more guy is there, please. Two of them are there. Yeah.
Hi, I'm Geetu from Kotak Alternate Asset Managers. So in the beginning, the first question was about factor timing, and all of you mentioned that multi-factor models where we can predict factor timing or where we can rotate factors as the best in terms of performance. But AQR and many other research firms say that it's almost impossible to time the factor. Looking at past, it looks like that, yes, we can. But like in the future, like we believe that it's very difficult. How successful you have been in timing the factor in your life funds?
Yeah, that's an interesting one. So AQR is the most mature organization, I believe, and India is an evolving market. So possibly.
A good quant fund starts with an accuracy of about 52% in being right versus wrong. Great one gets to about 54, 55%, and exceptional ones will maybe be sitting at 58%. If there are people out there who are crossing 60, I would love to know them. I don't know of them, and they may not be computing their accuracy correctly. So the thing is, think of this way. It's like weather prediction. Whenever you predict weather, you're almost always wrong. But do you generally get the direction right? And how often do you get right? And when you get it right, what is the margin you have? So when you're getting your factors correct, how big a gain do you have? And then when you're getting it wrong, how much are you losing? That gap is important, and the delta between what is the percentage times you are right versus wrong, that is important. Now, if you're running a factor timing approach on a single factor, it is nightmarish. I don't think so we have a way of doing it, and I'm restricting this conversation to long-only book right now. Long short is slightly different. But if you are increasing and decreasing weightages of in a multi-factor model, I think you don't get it right too many times, and you know, the accuracy maybe is 56% or whatever, but that is enough to make a massive amount of difference.
Alpha can be generated, you were saying.
Yeah. So I think we've been live for roughly 18, 19 months. After those 18 months, the first 12-month period, our models captured that we're in a value momentum regime. So for 12 riding that whole wave. I think in July 24, that's where my model said, okay, this seems to be over, move to like a quality and low vol regime. And I think over the last 6 months, quality low vol has pretty much been in favor. Even though we've not made major alpha in the last 6 months, say we are down 1.78% till December. Markets are down roughly 1.5%. So we've been in line with the market on the fall. But in the first year of rally with value momentum, we did roughly 77%. Markets did 35-36% on BSE 500. So as he said, when you get your factor selection and factor detection right, you make a lot of alpha. And hopefully when you get it wrong, you don't lose too much. So 3 methods of detecting, which factor. One, you chase the trend, whichever is doing well, you ride that. The other one is have a macro overlay. That, okay, based on these macro and market conditions, these are the factors that have historically shown some correlation to do well. And the third is mean reversion, which means quality has underperformed value for 3 years. It's at cyclical lows. Now it can outperform from here because the factor spread is at a multi-cycle low. So I think one of these 3 approaches should work, or a combination of these approaches should work.
Thank you.
Yeah.
I think we have last question and we can wrap.
Yeah, hi. This is Alok from LSEG. I'll just take a reference from what Sunil mentioned, or Sunil asked, how news feed could be one of the factors. I think the entire motion is for multi-factor. I think there is no debate. It's more of a toward the motion. So since you all 3 of you follow a multi-factor, and India being a momentum market, as a data company, we do a lot of factor model and work with the asset managers to test in different markets. Like in India, being a fund manager, it's a momentum market, and domestic flow, impact of the participation of retail through SIP has increased, and so has the social media. What is your perspective of news feed or news analytic? Like we have a model called market media sentiment as a model. That has a factor. What is your perspective to adopt or test that model in your fund management style?
Who's the question for? Sorry.
Both of the Rohit, Rohit and Siddharth, both of them.
Sure. So, as far as India is concerned, I think the data has been hard to come by or been very expensive. We are actually right now engaged with people talking about news data sets to analyze. I'm going to talk about my experience in US markets where I used to use news as a trigger. In my experience, great, but only for long short and short-term tradings. The signal goes to 0 within 3 to 4 days. Most of the action is on day 1. So today, if the news is happening today, if by tomorrow you have not traded, there is no signal left. So the decay is very, very fast. Ideally, you need to be in a, if not HFT, probably not needed, but you need to be in a mid-frequency setup where the moment news happens, you are trading on it. And you're trading very wide breadth of stocks. In Indian market, we'll see how much information is there as we analyze that. We haven't done that work so far. But it used to work very well with, let's say, if you're trading across 1,500 odd stocks in US and you're taking very large positions, the single factor model giving you single factor model backtest sharps of 5+ is kind of unheard of. A lot of value there. But no experience in India so far.
Okay. So with that, we wrap up the panel discussion. And thanks Siddharth, Ritika, Aditya, and Rohit for very, very insightful. Holding back the people on Friday evening till 6:30 is a commendable job done by the panelists. And thanks for coming on the dais to share the thoughts. Anyway, you guys can ask any questions once they get off the dais, and we can just wrap up the discussion here. Thank you everyone for hearing us out.
Thank you so much. With this, I would request, just a second, with this I would request Amit Atre from LSEG to come on the stage and give the books to the panelists. I would request everyone to still be seated because we have closing remarks and a last quick task to do. So